The foreign exchange or Forex market is the largest of all the global financial markets. As much as $5 trillion can be traded in a 24-hour period, 25 times the volume of global equities trading volumes. The Forex market exists as a global network of buyers and sellers who transfer currency amongst themselves at an agreed price. These buyers and sellers are central banks, corporations, businesses, and individuals. Even people changing money while traveling on holiday are essentially trading in Forex. The main Forex hubs are New York, London, Singapore, and Hong Kong. For this reason, the Forex market is open 24 hours a day and 5.5 days a week. This is a contributing factor to the huge popularity of this market, as traders can work to suit their lifestyles and other commitments. The mechanics of Forex are simple. In order to trade Forex, you would need to sell one currency in order to buy another. For example, a person who has euros and travels to the US on holiday would buy USD by selling the euros they currently own. However, Forex traders speculate on price fluctuations between the various currencies. They do this by buying or selling a Forex pair. A Forex pair is quoted as Euro-USD, which means that the euro is the base currency and the USD is the quote currency. If you were to buy or go long Euro-USD, you would profit if the euro strengthens while the USD weakens. If you were to sell or short Euro-USD, you'd be speculating that the euro is set to weaken against the USD. Ultimately, the market determines the price, as it tracks the supply of and demand for both currencies, which is influenced by news, macroeconomic factors, and politics. The Forex market is known for its high liquidity. From a trader's perspective, this is a positive thing, as a currency pair can usually be traded without significant price slippage. Slippage occurs when a trader opens a trade at a certain price point, but the order is filled at a different price point than that requested. Traders seek to reduce slippage by choosing markets with high liquidity. Volatility measures the expected fluctuations in a currency's price. There is an annual standard for these measurements, and they are derived from a currency's price chart. A currency is deemed to be highly volatile when there are major price swings that deviate in large and sudden movements away from the norm. Due to the enormous scale of the Forex market, it is difficult for a country, bank, corporation, or individual to manipulate the value of a currency for extended periods of time. This lack of manipulation is a major drawcard for Forex traders. Currency pairs are broken down into major, minor, and exotic pairs. The major currency pairs are those that trade the most daily volume against the US dollar. The most popular and highly traded currency pair is the euro-dollar, followed by the yen, sterling, and Swiss. Other majors include the Canadian, Aussie, and Kiwi dollars. The currency pairs that do not include the US dollar are often called minor currencies. Shown here are some examples of minor pairs that do still have high liquidity and volatility. An exotic pair has one major currency and a currency from a smaller country or a developing country. Exotic currency pairs are generally less liquid, and caution should be exercised when trading such pairs.